time for a recap of the bigger economic developments of the week. I am Devlyn Steele for Augusta Precious Metals. Here we go. Before we begin, remember to like this video and subscribe for more economic updates. On Wednesday, the Federal Open Market Committee released the minutes of its January meeting. The contents underscore just how cautious Fed officials are right now in their approach to managing the economy. The central bank did leave rates unchanged last month, keeping them at 5.25% to 5.5%. However, inflation persistence has prompted committee members to reconsider when they might pivot back to rate cuts. Fed Chair Jerome Powell effectively said last month that a rate cut in March was no longer on the table, and now there's doubt about whether we'll see one in May. The minutes released this week are largely a reflection of that posture, stating in part, most participants noted the risks of moving too quickly to ease the stance of policy and emphasized the importance of carefully assessing incoming data in judging whether inflation is moving down sustainably to 2%. Elsewhere, many analysts across the country who predicted recession a year ago have since backed away from those projections amid the economy's apparent resilience. Until this week, that is. Although the board revealed on Tuesday that its leading economic index declined in January for the 23rd month in a row, economists there are no longer projecting a recession at any point in 2024. The index fell 0.4 of a point last month, down to 102.7, the lowest level for the metric since April 2020, when the economic impacts of the global health crisis were unfolding rapidly. However, the index has seen key improvements in its component measures over the last 6 months, enough that the board now feels comfortable abandoning its long-standing recession forecast. Also this week, S&P Global checked in with the flash reading for its February Manufacturing and Services Purchasing Managers Indexes. Manufacturing PMI surprised to the upside, rising to 51.5 from 50.7 in January. The index had been projected to decline 0.6 of a point this month, but instead it was energized by the fastest rate of factory output in 10 months. As for services PMI, that surprised to the downside. Although it had been projected to decline 0.5 point this month from 52.5 in January to 52 even, it actually tumbled down to 51.3. In a press release, Chris Williamson, chief business economist at S&P Global Market Intelligence, said that confidence in the year-ahead outlook among service providers had declined in the wake of diminished expectations for interest rate cuts in 2024. Finally this week, the National Association of Realtors reported on Thursday that sales of previously owned homes rose 3.1% month over month in January to a seasonally adjusted annual rate of 4 million units. Still, the figure remains about 30% below the rate of sales we were seeing a couple of years ago. Analysts attribute the improvement last month to lower mortgage rates. However, there are signs that conditions may be starting to erode once again as rates tick back up. According to a report from Redfin, new listings jumped 10% year over year for the week ending February 18th. But signed contracts, an indicator of future closings, were down 7% over the same period. Thank you for watching. We'll see you again next week. I am Devlyn Steele for Augusta Precious Metals, signing out.